this kind of variance covariance matrix. And this is how when you have n assets, means n different securities, or here in this case M. So if you have M different security in your portfolio, this is how you are going to calculate expected return of your portfolio. And this is how we calculate standard deviation of portfolio, because these two are basic information, because whenever you are going to evaluate performance of portfolio, the basic input that you require is about portfolio return and portfolio risk. That is the minimum required. And then what you want to optimize, that is secondary. And I believe this problem we have also discussed, that you are creating a portfolio of two stock D and another stock BW, and 2,000 you are investing dollar in BW and 3,000 in D, and the standard deviation of these two individual stocks. These two individual stocks are 9% and 13.15%. Return and standard deviation, and for another stock it's this. So what would be the expected return? Your expected return and standard deviation of portfolio. So this is very simple case. First what we need is the weightage, how you are going to distribute your portfolio. So 40% you are going to put your available money in BW stock, and remaining you are going to put in DW. And here our assumption is W is sigma of WIs. What WIs? I'm saying that all the money is going to be invested. You are not going to save any money. Means all the wealth basically is going to be invested in these two assets. And this is how you can create portfolio returns are known. So getting portfolio average return is weight, how much you are investing, and respective average return of security 1 and similarly security 2. So this is how you got 8.4 as portfolio return. And the tricky part is, because this is 2x2 asset, so you will have 2 cross 2 matrix. And when you are considering this entire, as I know, if you remember your matrix calculation, so this when you consider, so you will have this term. This is going to be one component, so these two are going to be one component and these two. So this is how when you calculate your portfolio risk will be. So now using this, so this is basically simple application of these term, or here this is 3 asset, and we have 2 asset here. Now whenever we talk about risk that we measure in terms of standard deviation, it will have 2 components, systematic and unsystematic. As you know, systematic, when we talk about a factor that is causing risk, is macro factor, means across industry or across asset class you will have this risk. So this cannot be minimized. An unsystematic risk is basically your stock is specific stock, or you can call firm specific, and sometimes we call it idiosyncratic risk. So this is what we can minimize up to large extent. And when we look at number of securities and in your portfolio versus your standard deviation or risk, so this is how we can see that as you add more and more stock, and because of the correlation, inter stock correlation, what you will observe when you add more and more stock, in your portfolio, your unsystematic risk will come down. So this is what you know, but why it will come down, that derivation you will see in our subsequent session. And stock beta is basically measure of systematic risk. Remember beta, and you have calculated like this covariance between return of your security, return of your market, and variance of your market return. So what does it tells? It does the sensitive, it is a kind of measure about how sensitive your stock is with respect to market, and that's why we are calling as systematic risk measure. So your beta is basically systematic risk measure, beta I, beta of particular security I. And when we represent, in this axis, so here you have a stock return and this is your market portfolio. So remember, when you have beta is equal to 1 means your this angle will be of 45 degree. 1 unit increase or decrease in market will result as 1 unit increase in your stock return. And when we say beta is equal to less than 1, so in that case, what we are saying here, if you see beta is equal to less than 1. So what does it mean? The movement in your stock with respect to market is less than your market risk. So basically this angle is less than 45 degree. So already basic mathematics that we studied, if we put, so we can relate. And when stock is is very much sensitive with respect to market, so of course beta value is going to be 1. So this see, it means the angle or slope of this line is high. And when we are going to look at and if you remember, another way of interpreting this is, if you remember your CAPM model. In CAPM model, what you have is risk-free rate plus beta of security I, then RM minus RF. So if you look at from this point of view, so this is basically a kind of C plus MX or A plus MX. So here your slope factor is basically beta. So another way, when we are going to look at from CAPM model point of view, so your beta is basically sensitivity of your stock with respect to market, and that is very important consideration when we talk about portfolio. So this is what I was talking about. So in your previous example of two stock D and BW, so this is how we can calculate. So using the CAPM model, what we get is how much would be your required rate of return. It means if you want to invest in stock BW, in considering the market scenario, how much ideally you should get. So this suggests that your stock specific systematic risk is 1.2, and using this your expected stock return is coming 10.08%. So here first thing is, you can see that stock is having more systematic risk. 1 unit change in market return will result as 1.2% change in your stock return or stock a variation. In that way you can also put. And overall market return is 10%, and you from here you can easily relate that if market return is 10%, your expected return will definitely be higher than 10% in normal way if we consider. And then there are whether you are able to recollect or not, but these things if you have studied, that's fine. Otherwise we will be covering in this your portfolio theory is about market portfolio. CAPM model already but its application we will talk about. There are market market model abnormal return and measuring, performance using Jensen alpha, or measuring performance of your portfolio or a particular asset class, we can, calculate it through this. So this is, a what very basic. The initial CAPM model, remember, initial CAPM model is function of your index model, single index model. So what single index model is saying, that stock return or expected stock return is function of market return. And here, and if you compare this model with respect to your, CAPM model, in CAPM model, you get RF here, beta I, RM minus RF. So basically from single index model assumes that, there is a asset class which is risk less, or it is RF basically. Whereas in this case, you just talk about a particular stock I, and you look at the expected return for stock I with respect to market portfolio. And this we will be talking about. Yeah.
There was a doubt, like when you say that it's depend on the market return, what exactly constitutes the market return?
What I am saying, let's say if you are talking about a stock I, and this is, let's say you have entire basket. So what index model assumes? When we are going to talk about theory, we will again come back to similar discussion. What theory says that this stock basically belongs to this portfolio, this entire a basket of market. So this is market asset basket, you can say. So all assets are here. So when I'm looking at expected return of this, which is part of this entire market, so there is no reason to believe that this performance or return performance of this stock will be very much different with respect to market. And also because you are also considering the systematic risk of this security I. Systematic risk means beta is equal to, if you remember, covariance of these two. So already you are considering systematic risk of this asset, and we are assuming that this asset belongs to market, and that's why the expected return of this is going to be function of these two things, systematic risk of security and how market portfolio is performing. So based on that, this index model has been introduced. So this is very, basic model. And in this, if you know, basic regression equation, so this is error term, and this is the unexplained part. Why unexplained part? Because when we are going to talk about, alpha or Jensen alpha, but basically Jensen alpha, we are talking about unexplained part, right? So once we are going to talk about Jensen alpha, then you'll be able to easily relate that how your, these models are important in portfolio management. Right. So can we move forward?
Yes, sir. Yes, sir.
Yeah, so don't worry. So this is what you, if you have studied, that's good enough. Otherwise, we will be discussing, we'll be discussing all these model again in this portfolio. So why I'm doing this, so that, if you have done it, that's good. Otherwise, we will spend, more time if no one is aware of all these models. So this is basic, CML model, basically CAPM model. We call it capital market line. So what we have in capital market line, we have risk and expected return. So this way we plot. And CAPM model, if you remember, we say this is RF. And here, if we go back in CAPM model, if you remember how we plot it. So you will have RF here, expected return or return. You have, this line. Here you have sigma, basically your risk component. So any point P, if we take, So for, let's say for security I, or we are representing this line for some security I. So expected return is basically function of linear function of risk-free rate. And this is basically, if you look at here, RM minus RF. So here, if I'm saying, some point RM, so slope, so this, this will be your, what we call this slope is basically nothing but your beta. And we incorporate this further, change. So basically, this is the equation representation here. And if we further, substitute this, this part from here, this component, if we make adjustment, this component, this component will become your beta. This is your covariance, and in denominator you have, so this is your beta I. So this basically from where it is coming from your CAPM model that you have studied in your previous semester, or when I'm going to discuss about model, I'll also spend some time on CAPM model. And the characteristic line, if you remember, characteristic line is the relationship between stock return and market portfolio return. So just now, we have discussed previously, and the slope is basically your, we call it beta between your market portfolio and security. So there are, various application, as I said, that if you, that in Jensen alpha. So what is Jensen alpha? If you remember, Jensen alpha basically the portfolio return minus expected portfolio return, and this expected portfolio return is coming from CAPM model. So what it is saying, let's say for given point of time, when you observe that your portfolio return is RP, and when we calculate expected portfolio return or any particular asset class, is this. I'm assuming that RM is representing my some kind of portfolio of security I in a given market. So this is basically excess return. If you remember, so this is what you have realized, what you can observe, you realized, and versus this is what ideally you should go for this systematic risk, bearing this systematic risk. So difference between these two is nothing but alpha I, or this is nothing but we call it Jensen alpha. So what we are saying here is that this is basically your excess return on your portfolio with respect to your market. And that's why Jensen alpha captured. So this is how, if you look at Jensen paper 1968, you will find, this is how he has estimated. And Jensen alpha is one of the measure that tells you whether a stock is undervalued or overvalued. So for example, your alpha can have alpha for particular, portfolio or particular asset class may have 3 values, more than 1, equal to, because your alpha means either it could be positive, it could be 0, or it could be negative. So 0 we can put. So here basically we are talking about positive, here we are talking about negative. So 3 possibilities exist. So first talk about this possibility, means your realized is equal to how much theoretically you were expecting. So in this case, alpha value is 0, means your security or portfolio having similar characteristic that market portfolio having. It means there is some kind of symmetry in your return behavior or your portfolio performance. And here if you see, when in this region when your alpha is positive. Alpha positive means you are talking about you know you are talking about your underpriced or overpriced security. So your if your performance is your if your alpha of is positive, we call it outperformer. Whereas when alpha is negative, we call it underperformer or not performing. So this is why your use of Jensen alpha can tell you which stock is underperforming stock and which stock is overperforming. So underpriced and overpriced, and based on underpriced and overpriced, you can decide whether a stock should be added to your portfolio or not. So this is what you must have studied in your previous semester or in your basic corporate finance or theory that related to your two asset class or initial risk and return concepts. Now we will move to another because all these concepts you already studied, so I'm not spending much time. I'll be spending more time when we are going to talk about portfolio theories that related to these concepts. Can you all see my screen?
No, sir.
Now,
No, sir.
okay, let me reshare. Hello?
Yes, sir.
Sir, we can't see your screen.
Screen is not visible.
Hello? Hello?
Yes, sir.
Okay, sorry, there was some problem in MS Team. It got hanged and I had to restart MS Team software. So can you see my screen? Hello?
Yes, sir.
So we will go, quickly through all these slides. Already, most of the thing, if you are aware of business world and how things happen. So more or less, you all are know these things. So quickly, we will be going through, and then next module on Markowitz theory. We will try to start today itself. So as you know, when basically all the asset that we see in the market that are issued by some firm or by some other enterprise, and this is how in general we know underwriter helps and these different institutions issue, and once they issue, then these assets are basically are assets, and in this asset you can have a fixed income bond or you can have equity. So these assets are available, and then once these assets are available, so if you remember in our initial discussion, you have when we talk about portfolio creation, we talk about two things. First, you decide how much to invest, and then you decide where to invest. And when question comes where to invest, basically this question comes from the market itself, what kind of investment options are available. And these investment option will be available when a company through a certain procedure come out with asset class or certain investment options. And this is how when we talk about equity, so this is how performance of first day return, especially of IPO, initial public offering, are there across the world till 2016. So this is a paper by Professor Ritter, and he is known professor. Whenever we talk about initial public offering, he has written various articles. So this is how in Greece you will find returns are high, whereas when it comes to Russia, the returns first day returns were low. And again from same author, these are the overall scenario up to 2002 and regarding number of IPOs and daily average return. This is basically across world. So all IPO and then your number of and the first day daily return. And now how securities are traded. Basically, there are various type of market. First type of market is direct search, especially in direct search. What we see, we generally look at newspaper and then try to find out some buyer. If I want to buy, I'll be looking for seller. So here, when we look at the cost, so your search cost is high. Search cost is high, and also there are chances that if there is no designated market, then somewhere you will have to go for unstandardized bargaining. And second type of market that is we can classify is brokered market. For example, when you want to go and buy some kind of real estate or some kind of house or apartment, you try to approach some broker and they help you. So rather than like self search, so here through broker is still you are going to search for your asset. Asset is basically your physical property, but in this broker is going to help you. And third type of market, we call it dealer market. which is more transparent. For example, when we talk about NASDAQ is a dealer driven market. Now it is basically a mixed hybrid. Earlier it was purely dealer driven. So why we are calling dealer driven? Basically, if this is your NASDAQ exchange, so if this is your NASDAQ exchange, and in this I'm assuming that you have N dealers. So here 1, 2, up to N dealers you have, and these dealers are connected through your through broker, and then you have each dealer is connected basically M number of investor 1 up to investor M, and same way here different channels are there, here different channels are there. So when we say dealer driven market, basically these dealers represent some kind of market collectively here. So what happens if, let's say, you are trading with dealer 1? So when you submit your buy order, you are submitting buy order of, let's say, Microsoft MSFT. You submitted your buy order to buy a share of Microsoft on NASDAQ. So what will happen first? This dealer will see his own portfolio, because his portfolio consists of security holding of others. So first he will look at own, we call it order book. So dealer order book. So basically, what is dealer order book? Because dealer is dealing with the buyer and seller. So here selling details will be available and buying details. Because some buyer out of these M buyer, some buyer may want to buy and some buyer may want to sell. So if that is the case, so first he will look his or her own order book, how much buy and sell quantities are available. If available, he will match here itself. Otherwise, if it is not matching, then he will go to NASDAQ. And in NASDAQ, because all dealers are connected, so probably this dealer may have those securities. So through NASDAQ, this security will come to this dealer, and then ultimately he is going to serve this specific investor, buyer or seller. So we are not into very specific classification. So this is how dealer driven market takes place. Now coming back to fourth category, auction market. Auction market, you can think of NYSE, we have NSE and BSE. Another name of auction market, we call it dealer driven market. We call it order driven market. Order driven market means there is a continuous market where people are buying and selling. So this is not like physical auction. So of course name seems very close, but in broad classification of auction market is where you have continuous supply and demand condition, where you can submit your order, buy order or sell through certain channel, and then it is going to be crossed, or it is going to be executed or matched with counterparty. So basically, these are four broad type of market that we see around, and various type of portfolio creation, various type of trading happens. And now when it comes to type of orders, so we can classify orders into two categories broadly. One is a market order. Generally, market orders are also called liquidity taker. And these orders are called liquidity supplier. So why we call it liquidity taker? Because in market order, there is no condition. So what does it mean? Let's say when you are submitting a buy market order, and let's say you want to buy 100 shares. So these many shares you want to buy of particular stock, let's say IBM. So if when you are submitting market order, and let's say for we are assuming when you submit it at t is equal to 0, the price of IBM was $86. Now, when you are submitting a market buy order, what will happen? Whatever prevailing price is there, your order is going to be executed. Or so chances are very likely if you get 100 available IBM shares at $86, you can buy it. Otherwise, if price may go up, it means here your submitted order, what it is doing, it is taking away the orders available in the market, and that's why we call market orders as liquidity taker. They don't provide liquidity. Whereas when you put some price condition, for example, let's say you are submitting a limit order and you are saying that I want to buy a particular stock, this same IBM stock, when price goes below $85. Let's say hypothetically, if we assume, if this condition you are putting, it means until your price of IBM stock comes down, your order is going to be pending in the market. Means there is a liquidity, means there is an opportunity available for other side of market participant to trade with you. And that's why we call it liquidity supplier. Even if you look at, your SEC, Security Exchange Commission. So SEC encourage and they give some kind of rebate to dealers or brokers who provide liquidity to the market. Some they get incentive for providing liquidity. So it means if more volume is being traded by a particular dealer or broker, because it depends. Broker means your ICICI Direct, where they are going to just provide you a kind of channel. So if they are providing liquidity to the market, they get some kind of rebate or incentive. And when we talk about, yeah.
Sir, I did not understand how market orders are liquidity takers and price contingent ones are liquidity suppliers. Can you just repeat that part in brief?
Okay. So when we are saying market order, let's say when you are submitting, when order are going to be submitted, market order will get first executed. I hope you know. In terms of execution, your market order will get priority. There is I'll tell you because you have asked this question. So whenever we trade, there are certain things. First is priority rule. We call it priority rule. In priority rule, preference is given to price, then time, then quantity, and then other things like asset class or others. So it means if you are a buyer, and if you for a given time, let's say t is equal to 0, it could be 9. Let's say in India 9:25 a.m. Hypothetically, I am saying. So at 9:25 a.m. your order, you have submitted a buy order, and at that point of time your buy order having the highest. So let's say at this time other also submitted see, your order will be appearing in this order book if it is a price contingent, means you put some kind of condition. Otherwise, if it is market order, at that point of time, if orders are there, it will get executed. Otherwise, it is going to be cancelled. It means in market order, you have a high probability that order is going to be executed immediately, but you are not sure about the price. Whereas when you go for limit order, let's say you submitted a limit order. In limit order, you are saying that you will buy if stock price for particular targeted stock price comes down to $100. Let's say you have submitted here. Same way, there could be many other orders. So even if you go and look at NSE website, they provide 5 best bid and 5 snapshot of 5 best ask prices. Ask means selling price and this is buying price. So it means according to NSE priority rule, if on a given time stamp, if 10 orders are coming, so order having that is offering highest price will be going to be executed or will get the priority. Then if all orders are coming at 925, so first preference is price. If price are all same, let's say all 5 or 10 orders, whatever is reflecting here in the book, then next is which order came first. That order will get priority because chances are very likely that 5 different investors, they have submitted same price order or limit order having same kind of price condition. Then order that came first, that order will get priority. And if both are same, then who wants high quantity or who is providing more liquidity? So this is what priority rule we follow. And your question, why we call market order is liquidity taker, because when you submit order, it is going to be either executed or it will cancel. It means if it is getting executed, so all the orders available are going to be 0 or it is going to be reduced. For example, let's say at any point of time, 100 stocks were available, means these were available for sale, and market order comes and that order comes to buy, let's say 900 stock. So immediately after, let's say if this is T is equal to 0, and T is equal to 1, when this order comes, immediately all 9 orders are going to be adjusted. So next moment, only 100 orders will be available. 100 sale or quantity will be available. So what is happening because of this immediate order or market order, your available sellable quantity or this quantity of a share reduced to 100. Means if another order comes probably of 900, that person will have to wait. And that's why market orders are called liquidity taker. They don't provide because either it will be executed or if nobody is there, then immediately it will get cancelled. Otherwise, it will take out whatever volume is available in the market. Whereas price contingent, you are putting a condition. So unless that condition is not met, your order will be pending or it won't get triggered. So another way we can call it trigger. So that's why market orders are liquidity taker, and your price contingent order, stop order, limit order, or any such kind of conditional orders, we call it liquidity provider because they will be reflecting in the market or in order book.
So shouldn't price contingent orders be said that they are not liquidity takers rather than saying that they are liquidity suppliers? Like, I don't see why would they increase the liquidity. I understand they won't take away as much liquidity as market orders, but how are they like supplying liquidity?
Because their orders are going to be pending in the market unless it is triggered based on given condition.
But the amount of, if their conditions are not met, the amount of stock or the number of shares, those won't go down. So that's why we are saying that they won't take away liquidity.
Yes.
Okay.
Actually,
so
if
these types of orders, which type of market do we place these orders? In which type of market do we place these orders?
Even even if you have any trading account, or if you any one of your friend is good in trading, so you can go and look at whenever, let's say whether it's SDFC Security or ICICI Direct, you will find when you are submitting order, it will ask you what condition you want to put, buy, sell, what trigger price you want to put. So all those options you will get. And that's why even when we define liquidity, liquidity is opportunity available for buyer and seller to trade. And that opportunity will only be available when there is some price contingent or price condition. Otherwise, even if you go and look, because I have done, written various paper on this market order and liquidity. So even in order book, you won't get this information, market order. Reason is very clear, because this is a kind of, market came and disappeared. Why it is happening? Because this is a market order. You cannot capture. Of course, if you classify, you can see these many market order came. But when we talk about order book basically a kind of, so this book will tell you, all the information about limit order. How many orders, came in the market and traded. And that's why, we call that order book basically a limit order book rather than market order book. We call it limit order book because in this, data set or in this, information set, you will get the details of limit orders or contingent orders. Is it clear?
Okay, sir, I got it, sir. Sir,
Yeah,
one
so,
question.
yeah.
Sir, we discussed the different types of markets. Which of these do stocks sold and or securities bought and sold at standardized prices? I think in direct search markets, you wrote something about bargains.
Yes. I think I'm not able to understand your question. Can you please further, make it easy to understand?
So I was just asking that, is it that in all these kinds of markets, like if I have a share and there's some market value of that share, like is it possible that someone can sell that share for a higher or lower price depending on what the shareholder wants? Like if I want to sell it for a higher price and someone is ready to buy it for that price.
So actually what happens, there is a concept of tick size. Tick. So let's say you want to sell, a stock at 100 rupee, hypothetically. In India based, I think 5 paise is, a tick size, minimum tick size means you can increase or modify your order based on 5 paisa step, right? So it means, let's say you want to sell at 100 rupee. And in market, when you see your, you are not able to sell it. And buyers are, saying that I'll buy when price goes down to this level, 99, let's say 99 we should call 99.70. So it means if you really so either you wait till market adjust the price and you get your expected price 100 rupee, or you revise your order. Let's say you come down from 900 to, let's say, 99 rupee and 80 paise, and this person buyer also, they also because if you both are not modifying your order, you won't be able to change. You won't be able to get stock. You won't be able to execute with each other. So buyer can also modify. He may think that I need to upgrade my price. Let's say I should make it this. So unless this kind of adjustment happens, buying and selling cannot take place. And that's why many times it happens. Let's say you set price that I want to sell at 100. Entire day you are not able to sell that stock. And it is happening because of two reasons. First, buyer thinks your price is not appropriate. Our price seems at the higher side. So that is happening because of information asymmetry, or another way is because of less liquidity. Why less liquidity? Because you are not getting buyer. So this is how it happens. And when you put price condition of orders, so it, unless you give some additional instruction, you modify your order or you change it, it is going to be there.
Okay, so this is where market orders are bad, because if I'm trying to sell for 100 rupees and no one is ready to buy, then my order will be cancelled.
No, but in market order, yeah, market order, if somebody is available, it will be executed. Otherwise, immediately it will get cancelled.
Okay, okay.
And that's why we are calling market orders are basically liquidity taker, right? So
Okay.
now coming back to trading mechanism, already there are various trading mechanism. One trading mechanism we call it through dealers, like Nasdaq example, where dealers are going to play a role of exchange. Each dealer is similar to exchange because first dealer will match order from his or her order book, and then if it is insufficient, he will pass information or order to the exchange. And second is, now across world you will find all the stock exchanges are having some kind of electronic communication network. Through that trading is happening, and across market you will find specialists. They are readily available to help their client by charging some additional cost. And this is very interesting. This is paper by Chodia, Roll and Subramanian. It is related to market efficiency. And what has happened in US, basically there was a regime, three regimes. So up to 1997, the tick size, if you remember, I said that in India tick size is 5 paise. So zero, these many paise means if you want to modify your price level, you will have to modify in the step of 5 paise. So in US, actually, there up to 1997, July 1997, tick size was 1 by 16th. Sorry, 1 by 8 dollar. It means you will have I think it is going to be 12 point how much around 25 cents, right? So this was 1 by $8 tick size. Means if you want to change your order, you will have to change it by this much dollar. This is going to be dollar. And then what is observed in 1997, this was reduced to half. The tick size was reduced to 1 by 16th dollar. Means the variation earlier, you were this much money was required, or this much step you can follow. And then after 1997 up to 2001, the tick size came down to half of previous. So what is observed, the effective spread is one of the liquidity measure. So effective spread, basically what is effective spread? Trading price minus mid order. Mid order means what we are saying, mid quote, or mid quote means ask price at time t plus bid price at time t divided by 2, and this is absolute value. So basically effective spread in terms of dollar came down. It means liquidity has improved basically. And further what has happened, then there was decimalization. And when decimalization means in decimal, and you can think about when it is 1 by 8 and 1 by 6, it is very difficult to get exact number. Generally, human being, we prefer 5 paise, 10 paise. We don't prefer 2 by 3 rupee or 1 by 13 rupee. That kind of calculation is difficult to do. But in US, it was in trend. So what they have observed, that when this kind of regime in terms of change in tick size happen, liquidity has improved. Basically, this is spread is a kind of cost. Spread is a measure that captures the illiquidity. So this effective spread, and this is two-side effect spread, because you can buy on and sell. So that's why we multiply this by 2. So what basically they have observed that when this kind of regime were changed, overall spread has came down, and almost you can see around it came down from this much $0.12 to 0.05. So there was improvement in liquidity. So this is, one of the known study that talks about tick size, how trading has, changed the market liquidity. Now coming back to current trading strategies, especially when we talk about portfolio, especially when you go and look at intraday portfolio creation, especially related to equity, you will find these terms. So what these terms are, by name itself, when we say algorithmic trading, basically we are talking about algorithm. So there is no manual, order submission and execution. Everything is going to be done by the computer-based program. And if in India, even across world, if you want to use algorithmic trading for your client, you will have to verify your algorithm or your, code. You will have to submit to respective exchange, NSE or BSE, and their team is going to verify, and then only they will allow you to trade. It means your identity is going to be known. Then only you will be allowed to trade on NSE and BSE on behalf of your client. So this is what rules are there so that no one can misuse. Another concept that you will come across is high frequency trading. So basically high frequency trading means in terms of speed. And there is a term we call it co-location. So what is co-location? There is a concept in recent literature or related to market that if your NSE building is here, this is your NSE building, and here you have one floor, you have NSE exchange. So co-loco actually to take the advantage of high frequency order submission, NSE allows or exchange allows various firms to keep their server close to NSE server, so that using the speed they are able to able to trade frequently or quickly on behalf of their client. But for getting this kind of access, this is access close to NSE server, these will have to pay high cost for establishing or keeping their server very close to exchange. So this term we call it co-lo or co-location. So this helps that these firms to quickly execute. And in India right now, if you go and look at minimum time stamp is in GIFE, JIFFE, GIFE. So what is GIFE? GIFE is basically 1 second divided by 36,652. So what does it mean? Around in India, we are trading around a microsecond lag. This is if order is available, the execution speed is in microsecond. Whereas in US, now trading is happening in nanosecond. Nanosecond. It means in terms of order submission and execution, US exchanges are around 1,000 times faster, more or less, as compared to NSE. But now NSE is also doing various things to further improve order submission and execution speed. And dark pool, basically, these are the trades which are anonymous. And generally for this, you will find OTC market. OTC market is dominating because when you trade in exchange using any of these two channels, at least up to some extent, your identity is going to be revealed. Whereas if you want to go for large buy or sell, you would prefer to use parallel market, which is basically anonymous market where you can hide your identity and trade. So there were, various criticism on dark pool market, whether it should exist or not, because ultimately it impacts normal trading activity. This is the, I think a few slides are left. Okay, so this is what, across market you can see. So there is a website by World Federation Exchange. So this is the size of market, basically exchange in 2016 across the world. Okay, so what we will do, we will stop our discussion here, and I'll upload all these slides. So I'll be uploading these slides, of course, margin part, because already we have covered most of the basic concept related to market. Now we will, what is left in this slide is, our discussion on margin and then investor equilibrium. So I'll be uploading both the slides, previously discussed slide and this, and next week onwards we will be focusing on theoretical part, basically your Markovitch EV theory and various portfolio models. So now you all will have almost same grounding, whether you have studied this kind of topic or course previously or not. But now I believe everyone will have same footage. Yeah, and if you have any question, I'll take it. Otherwise, we will stop our discussion. And both the slides, previous one, where we talk about basic concept, assuming that